It's time for Ask Annex. Got a question? You head to our website, annexwealth.com. In the studio, Sarah Kyle, Wealth Manager at Annex. Welcome.
Hi, Danny.
And Matt Morzy, Investment Team Manager. Welcome.
Hey, Danny.
First up, recently my company stopped matching our 401k contributions. I'm looking for some information on possibly next move. Doesn't look like the 401k match is returning. Is there another product to move that 401k to that I can start putting monthly deposit into?
Well, there's no law that says you have to move your 401k. You could keep it there. And there's something to be said about just that ease of having that pre-tax money come right out of your paycheck to go into your 401k. If you no longer wanted to contribute to your 401k, you have some other options. You can contribute to an individual IRA. You can also look in to see if you're eligible for a health savings account. Now that's pre-tax, gross tax deferred, and comes out tax deferred for qualified medical expenses. But we talk a lot on this show about also the tax diversification. So there's nothing wrong with, even if you wanted to start, not contributing to a qualified account, but a non-qualified account. If you wanted to start putting a certain amount every month into an individual taxable account, that'll give you some tax diversification later on. You can withdraw that money before 59 and a half, and it also give you some spending flexibility later on in life when you're retired.
Yeah, I think that's why financial planning is so important, and looking at what your overall plan is for a decision like this. When they're not matching your 401k contributions, that does take away some of the advantage of using that account because you're not getting that free money anymore. Like Sarah, you mentioned, just that ease of having that money coming out of your paycheck every single time really trumps a lot of the other things, because if you have to do it yourself, you might not. You might decide, hey, this month I'm going to buy something else, or maybe your spending starts to go up because your paycheck's bigger and you don't have that money going automatically there. But it does allow for a lot of that extra freedom, like you said. The HSAs, which are incredibly powerful, we've talked about that in the past on Ask Annex of how great an HSA plan is, especially when you can invest it, changing that tax diversification as well. But that's why I think meeting with somebody like Annex and looking through your financial plan and really seeing what's the best way for you to save, that's going to help you long term is what you're going to want to look at.
Talk about that ease of putting it in the 401k. It's almost like if you don't see it, you won't spend it.
Exactly.
Next up, what are the strongest sectors within the S&P 500 and how cyclical are they?
Yeah, that's a great question. And as the market's moving this year, we've seen a big difference between the first month or so of the year. And there's a big stretch where tech and consumer discretionary really ran on the back of NVIDIA and the AI boom and some of the changes in terms of what the Fed did around switching from quantitative tightening to having to flush some money into the system. So a lot of those sectors took off. When we look at it so far year to date and trying to look at mostly the cyclical side, which is basically what's the most sensitive to the economic cycle, technology is up 31% or so at this point. That's the number one sector. Some of the more other cyclical areas, you're looking at industrials. That's the third best performer in the S&P 500 so far from a sector standpoint. So you're seeing some of those stronger ones be there. That's kind of the areas that I would watch out for. Is they've done really well because there's been a backdrop of the soft landing, and that's kind of what people have been kind of pushing their investments into, is this belief that we're going to get that. If we do get the choppiness that we've seen over the last month and that continues, you're going to see a lot of those areas start to pull back though. So that's what I would watch for, is do we really get that soft landing? How comfortable are you in that? And then whether or not you want to take that ride with it or not.
Talking about cycles, if you ever have taken a look at that Callan chart, which shows how stocks and sectors have performed throughout the different years, sometimes that best performer in one year is going to be the worst performer the next year. Look at tech last year at the end of the year. It was one of the worst performers. It's one of the best performers this year. So just want to make sure you're very diversified.
Yeah, you certainly want to have that. And even within some of those sectors, they might be classified as cyclical when something like Morningstar or FactSet or Bloomberg takes a look at it. But there's going to be companies that are going to be all over that map that fit within those. So that's why stock picking as well is really important when you're trying to do that. You might not necessarily want that full sector when you're looking at it.
Final question on Ask Annex. My newly graduated and now gainfully employed son is serious about saving and investing. He's active in the 401k at work but wants to, quote, take the next step. I'm unsure what that should be. I don't want him to start with individual stocks where he could lose significantly by chasing headlines. What's the next step for 401ks? ETF?
Yeah, that's a great question. And certainly individual stocks pose additional risk. You really want to know what you're getting yourself into when you're buying an individual stock, because you're losing that diversification benefit you have with an ETF or a mutual fund. You still have that same risk when you're looking at sectors, as we were just talking about. Technology was the worst sector last year. It's the best sector this year. Those things can move around quite a bit. But you want to make sure you're comfortable in what you're doing. I would, if I'm that person, I want to make sure I know what I'm doing within that 401k. I don't want to duplicate that someplace outside of it, but certainly things like ETFs, mutual funds, sitting down with somebody who can walk you through what your portfolio looks like, help you with managing what that risk level is, and maybe even doing it for you is really a good option.
When you don't have that large balance at the beginning and when you're starting to contribute to that taxable account, ETFs are a great way to get that diversification. So just use that until that account grows. Some people use the rule of thumb of $10,000 and then they can start diversifying. But you have to have that balance in order to be able to get full diversification via stocks before you start investing in individual stocks.
Sarah Kyle, Wealth Manager at Annex Wealth Management. Thanks.
You're welcome, Danny.
Matt Morzy, Investment Team Manager. Thanks.
Thank you.